Hey everyone, welcome back to Corporate Decoder, the place where we tried to make sense of the confusing world of business filings, and today we're looking at Arrive AI Incorporated's latest report, and let me tell you, it has got some interesting moves that might just change how they play the money game. Before we dive in, if you like decoding these SE filings and getting straight talk on what they mean for companies, hit that subscribe button. Also, we've got a fantastic Discord community where we chat about these things all the time. The link is in the description below, so definitely check that out. This is an 8K filing, which means something significant has happened at Arrive AI Incorporated, and they're required to tell the US Securities and Exchange Commission about it. Fast, think of it like a company's urgent broadcast to the world. The big news here is about a financing deal, and it's not a simple one. Arrive AI Incorporated, or the company as they call themselves here, has inked a deal called Prepaid Purchase Number 3 with someone named Streeterville. Now, this happened on the 3rd of December 2025. It's part of a larger agreement they had already made back in March of the same year, called the Streeterville Purchase Agreement. So what exactly is this Prepaid Purchase Number 3? Think of it like this. Streeterville is giving Arrive AI Incorporated $3 million right now. In exchange, the company is issuing Streeterville a promissory note, which is basically an IOU, but this IOU is for $3,240,000 with an original issue discount of $240,000. What does that mean? It means Streeterville is essentially paying less upfront for the note than its full value, which is a way for the company to get cash now while giving the note a higher face value. This note carries an 8% interest rate compounded daily. The really interesting part is how Streeterville can get its money back, or at least a portion of it. They have the option to convert amounts they are owed into the company's common stock. There are some rules here though. They can only buy shares at the lower of two prices. The first is the initial listing price of Arrive AI's common stock on the Nasdaq Global Market. The second is 90% of the lowest trading price over a 10-day period. But they can never buy shares for less than 25 cents each, which is a floor price. There is also a limit, a safeguard, so Streeterville doesn't end up owning too much of the company. They can't acquire more than 9.99% of Arrive AI's stock, and these shares they get must be freely tradable, meaning they can be sold without further restrictions. Now, Arrive AI Incorporated has a way out too, of sorts. They can choose to pay back the money early, but it comes at a premium. If they want to prepay, they have to pay 1/15% of the principal amount they're repaying. They need to give Streeterville 5 trading days notice, and there are other restrictions on top of that. The company is obligated to make monthly cash payments of $412,500 plus interest. These payments kick in under certain trigger events. What kind of triggers? Well, if the stock price falls below that 25-cent floor for too long, or if issuing more shares starts to get close to a point where the company would need shareholder approval. This sounds like a way to protect investors if the company's stock is really struggling. Streeterville also has an ace up its sleeve. If certain events of default happen, like the company not paying, going bankrupt, breaking promises in the agreement, or certain big corporate changes, Streeterville can force the company to pay back the entire outstanding balance immediately, plus a hefty default interest rate of 15%. So this is a financing deal that has some teeth for both sides, and it seems geared towards providing immediate cash for Arrive AI Incorporated while offering Streeterville a potential return tied to the company's stock performance and downside protection. The deal also involved a placement agent, Maxim Group LLC. Maxim is getting paid a fee. They received a cash fee equal to 6.0% of the gross proceeds that Arrive AI Incorporated got from this deal, which was $3 million. So, Maxim gets a good chunk of change for setting this up. They'll also get a similar fee for any future paid purchases made under this same Streeterville agreement. Now, this next part is important. The shares of common stock being issued, or that could be issued through the Streeterville agreement, are being offered and sold without being registered with the SEC. This means they are relying on specific exemptions from the standard registration requirements, like Section 4A2 of the Securities Act of 1933, or Rule 506 of Regulation D, or even Regulation S. Basically, these are considered private placements, not public offerings. This is common for companies seeking quick financing. Finally, the filing lists the exhibits. The most important ones here are Exhibit 10.1, which is the actual prepaid purchase, Number 3 agreement we just talked about, and Exhibit 104, which is the cover page interactive data file. Now, let's zoom out and think about what this all means. Arrive AI Incorporated is in a position where they need cash, and they've secured it through a deal that involves issuing debt that can convert into stock. This is a double-edged sword. On one hand, it provides immediate funding, which is crucial for growth or operations. On the other hand, It carries the potential to dilute existing shareholders if the stock price goes up and Streeterville converts debt to equity, or if the stock price falls, triggering repayment obligations. The terms are quite specific. The conversion price, which is tied to the market price and has a floor, suggests Streeterville is looking for a reasonable return and downside protection. The mandatory repayment triggers based on stock price and issuance thresholds are critical. They indicate Arrive AI Incorporated is trying to manage its cash burn and avoid actions that could harm its stock price further or require shareholder votes due to dilution. The role of Maxim Group LLC as placement agent is standard for these types of transactions, and their fees reflect the service of connecting companies with investors for these complex financing arrangements. Looking at this from a Warren Buffett perspective, we need to understand the underlying business. While this filing focuses on the financing, it doesn't tell us how Arrive AI Incorporated is actually performing operationally. Is their core business strong? Are they generating revenue and profits? This financing deal is a symptom, not necessarily a cure. If the business is fundamentally sound, this cash infusion could help them achieve profitability. If the business struggles, this could just be a temporary fix that comes with future dilution or repayment pressures. The fact that they are issuing shares under exemptions from registration means they are likely still in a growth phase, or perhaps facing financial challenges that make traditional bank loans or public offerings difficult. The 9.99% ownership limit for Streeterville is a common feature to prevent a single investor from gaining too much control without a full buyout. What are the risks here? The most significant risk is that the company's stock price may not perform well, leading to the mandatory repayment obligations and potentially default, if they cannot meet them. Dilution for existing shareholders is also a major concern if the stock price recovers and Streeterville converts their debt. The 8% interest, coupled with the original issue discount, represents a cost of capital that is likely higher than traditional debt, reflecting the risk Streeterville is taking. An opportunity here lies in how Arrive AI Incorporated uses this capital. If it is invested wisely in product development, market expansion, or improving operational efficiency, it could lead to future growth and a higher stock price benefiting all stakeholders. However, the trigger events suggest to raise a real concern about the company's ability to maintain its stock price above the floor. In conclusion, this filing reveals a company actively seeking and securing crucial funding through a structured debt. To a equity financing agreement, the terms are complex, designed to protect the investor while providing the company with much needed capital, but also impose significant obligations and potential future dilution. Arrive AI Incorporated's success will depend on their ability to leverage this funding effectively and turn its operations around, or at least improve them significantly, to meet its financial commitments and grow its shareholder value. What is your take on this financing deal? Do you think it is a smart move for Arrive AI Incorporated, or are the risks too high? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more deep dives into corporate finance. And don't forget to join the conversation on our Discord server. The link is in the description. Thanks for watching, and I'll see you in the next one.